And I don't think it's down to us as traders to make the world a moral or immoral place. We don't really have that control, do we?
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. It's Walter here, and I've got Darren on the line. Hello, Darren.
Good afternoon, Walter.
So, Darren, we were just talking about this right before we hit the record button for today's episode, and I'm wondering about your thoughts. I have some thoughts on this, but there was a interview a few years ago from a gentleman in London. I think his name is Alessio Rastani. I'll put the interview in the show notes for everyone, where he was talking about, they were interviewing him on some financial channel or whatever, and he was an independent trader in London, and he basically said that he was dreaming of the next GFC. that he couldn't wait, and then it's like every night he goes to bed wishing for another GFC. And so the question is, for today's podcast, and the reason why this is pertinent to me is because I've heard these rumors. We're recording this on the 2nd of November 2017. I've heard these rumors that there is something really crazy that's about to happen and that it's going to send a shock through the market. So whether or not this comes true, we'll find out in the future. But the idea is it moral, or should you want to try and profit from terrible things that happen in the world? Like, what are your thoughts?
It's difficult, really, isn't it? You know, as traders, essentially, you're always trading good news somewhere against bad news somewhere else. And, you know, you could argue that we're kind of profiting off other people's misfortune. But, you know, and I suppose if someone wins a trade, then somebody else has got to lose a trade. And generally, there's more losers than there are winners in that. So you could argue that morally it's wrong. It certainly would be wrong to wish hardship on other people, I suppose. But I don't think as a trader you can consider yourself being immoral because of that. It's a difficult question, really.
Yeah. I mean, like, thinking about when I look at the charts, what I look for is volatility. And so volatile markets get me excited, and volatile markets are the ones that I typically will find to trade. And so with that comes some sort of news. Generally speaking, you can point to the volatility and say, well, that's because so-and-so said this or whatever. And so, but then again, it's the reaction to that. So just because there's volatility doesn't necessarily mean that it's bad news. I suppose you could have good news for just about everyone. I don't know. I mean, I guess your point is, so here's an example that I remember from a few years ago. There was some news that it affected the New Zealand dollar. And the news was, it was early in the week. I think it was a Monday in Asia. So it was right when the markets opened for the week. And there was some news that came out of New Zealand about the fact that China wasn't going to buy New Zealand milk for some reason. Like, it may have been tainted or expected to be tainted or something. And the dairy business is a big business in New Zealand. And so the New Zealand dollar fell. So in some ways, that's bad, right? The dairy industry is being affected by China's stance on, we're not going to import New Zealand milk, right? But then the traders who were shorting the New Zealand dollar were happy, right? Because their positions magically moved into quick profit or whatever. So, I mean, it's kind of like one of those things where I feel like if I'm looking for volatility in the markets, and I suppose some traders don't want volatility, there would be some that really like low volatility markets, and they're looking for the market to stay constrained, and they use that those borders as places to contain their risk, and so that makes sense. But I'm looking for that. So I don't know. I mean, I don't know if it's possible to have news that creates volatile movements in the market that's kind of good all around. I don't know. Yeah,
probably not really. The other argument I hear a lot about trading is that, we don't actually contribute anything to society. We don't actually produce anything. It's just, money's just kind of passing from one person to another, and it's not actually improving the world we live in. But I guess with a lot of stuff in life, you kind of have to accept that and try and make up for it in other aspects of life. It certainly doesn't keep me awake at night thinking whether I'm being a good person or not because I'm a trader.
Yeah, I completely disagree with that, and I've heard that quite a bit as well. And I think that the way that I see it, it's the people who are speculators in the market are sort of like the oil in the engine that lubricates the machine. And if you don't have enough of them in there, then you're going to end up with one of those markets where there are no real smooth price movements. It's really choppy, and things kind of ratchet up and ratchet down. We've all read stories in, for example, like the market wizards. I think there was one interview where one of the market wizards was saying that he was in a lock limit. He was in a position in the futures market. And apparently, I don't know if this is still true, but apparently there was a rule that if the market goes down a certain amount, then it's like, that's it for the day. It's not going to trade anymore. Like, it's kind of locked. They call it lock limit. It can only go so far, and then it's locked there, which basically means you can't get in or out of any of your positions. And he was talking about like 10 days in a row, the market was at lock limit on the open. So he was stuck in this position and he was underwater. And every day he was waking up hoping that he could get out of it, and he couldn't. Well, see, that's the risk that we take as traders. We take a risk. If you were in a position and then the Swiss National Bank on January 15th, 2015 makes a surprise announcement, guess what? You get wiped out. Like, you're the one taking the risk as the speculator, and you're the one that's greasing the wheels. Now, obviously, the real lubrication for the foreign exchange market is through the banks, right? The banks are the ones that are doing that. But the point is that if you didn't have speculators in the market, you would always have a situation where the prices would move herky-jerky. The more people participating in the market, the smoother the charts look. To me, that's the attraction to Forex, is that you have these really beautiful charts. You don't have so many gappy movements that you see in a lot of share markets. And so I like that from a technical trading point of view. That's what I like about the beautiful looking currency charts. I don't like the ones that are really choppy and gappy and herky jerky, and that's what we contribute to the markets. Like, I see it as that. So I understand why people say that and claim that you don't add anything to the market. But if I go to a psychologist and I sit with that psychologist, and the psychologist gives me a 60-minute session, and at the end of it, I think, why did I just pay you $250? I don't feel any better. I mean, did that psychologist not add anything to the market either? You know what I mean? Like, do you know what I mean? Like, I mean, you could make that argument about a lot of things, I suppose.
Yeah. Well, what do you think of this idea that essentially, especially with currencies, that it's already decided where the price is going to be in 6 months' time, and the central banks have already agreed, right, this is where we're going to set the dollar, and no matter what anybody else does or what the news is generally in between, that's where they're going to put it. Do you agree with that or not?
No, I think that's ascribing too much power to, in Australia, there's a lot of talk about the Reserve Bank of Australia, which is the central bank, says that we want the dollar here. We'd like to see it down here. And for months and months and even years, the Aussie dollar didn't fall to the point where they, quote, wanted it. I think that's kind of I think we're giving them more credit than they have. I think, for example, the classic example is the Bank of Japan. You can go back on the bank. You can go back on those yen charts, especially, between 2005, 2010, and you can see where the Bank of Japan was selling yen and buying euros, and they wanted that chart to go up. Okay, they wanted the euro yen to go up. They wanted the USD Japanese yen to go up. In other words, they wanted a weaker yen. They wanted cheaper exports. And tell you what, they spent a lot of money trying to get that to happen. And you know what happened every time?
It snapped straight back, wasn't it?
Yeah. I mean, you've seen it. I mean, I know you've seen it. I remember seeing. I'm like, this is crazy. They're just throwing money. And so, to me, that's just the classic. The market will go where it's going to go. And I mean, I think in the short term, maybe you can affect it for sure. And I know that's done. I've talked to people at investment banks where they say things like, oh, we their trading desks, the biggest trade of the year is when they pay everyone. They know that their bank is going to pay everyone their end of year bonuses, and so they actually put in like a currency trade ahead of that. You know what I mean? Like knowing that they're going to affect the euro and things like that. So I've heard of things like that, but that's usually kind of a short term thing. So I don't know that you can necessarily hold up a currency or keep something depressed for a long time. I think the market generally wins on that one. What do you think?
Yeah, I don't believe it. I've just I listened to some podcasts from a hedge fund guy who he strongly believes that it's all predetermined. I can't remember his name now. I will dig it up for the notes, but he basically predicted DAX over 12,000, and he made all these predictions about markets and where they would go, and because he has this belief that it's all predetermined where it's going to go and nobody else can interfere in it. But again, he might have just been in a rising stock market to call new highs. Could just doesn't necessarily mean you can predict what's going to happen in the future. Do you think on this notion though of traders wanting bad news, do you think that now with arguably some sort of crazy political decisions and for instance Trump, you expect Trump to do something unusual and shake stuff up, so do you think traders are kind of happy when that's more the case than when we've got the outcomes that everyone's expecting? Are we generally happier with people like Trump getting in? I mean, I know this is kind of getting a bit political now, and some people will argue that Trump's going to be really good for the economy, but there's a general feeling out there that he's going to do something different, shall we say. Yeah,
so that in itself, when you look back at 2016 on the election day, that was really interesting to me because, the general expectation was not only that Clinton would win, but that the market had priced that in. So what was interesting, if you look back at those charts, as you see, the market did a 180. So there were two things that came up. One was it was a surprise result, right, to some, and then the other thing was that it was like people were like, hang on. He's a Republican, like he's a conservative. Maybe this isn't going to be so bad for big business. And then, the stocks all kind of exhaled and said, oh, he'll be all right. You know what I mean? And then they turned around. So it was like there was two things going on there. If I put on my funny mentals hat, the first thing was surprise. And the markets don't like to be surprised. They don't like uncertainty, and they don't like to be surprised. If I had to hang my hat on a couple of things, I would say you could look at the markets in a general point of view, like this is really simplified. There are those times when the market is feeling like it kind of knows what's going to happen, like it has a pretty good idea, and in those times people are pretty okay with taking on risk. So there's kind of like the pro-risk market, which is when everyone's like, yeah, we have a pretty good idea what's going on here. And then there's the fearful market, which is like, holy crap, I can't believe, that happened, and who knows what's going to happen next, and I'm so scared, right? So like that's kind of the fear and the greed, right? And so I think I would argue that that's what is really going to drive the big swing. So when you have things like the GFC or Franco-Geddon, you get these surprise results, surprise things come in, and everyone just freaks out and they just go crazy, and that leads to the cascading. It's fear, really. Yeah. It's fear of the unknown. We don't know what's going to happen.
And which of those is which one is the market to trade? Which is the one that we want?
Well, yeah, right. Well, obviously, the fastest way to make money in a market is to ride the collapse of a trend, like the end of a trend. So the market's been going up for 3 months, 4 months, 6 months, 6 years, whatever, and then the uptrend is over and it collapses. Like that's and you can go back and look in August 2007, you can look in August 2008, and you can see that in September 2008, you can see this, right, on the charts. Like these big, huge candles pop up, and especially on volatile pairs like the pound yen, you'll see those pop up then. And so so that's, if you had to say how am I going to make a lot of money quickly, it would be the end of the trend. People are freaking out and they're just like, it's complete cascade. Right? Yeah.
Yeah. You need a shock to trigger that.
Yeah.
It doesn't just kind of come to an end. It comes to the end from a fundamental shift. Something has to trigger that, doesn't it?
Yeah, but isn't it interesting? Like, I know you're a big fan of Nassim Taleb, and is it interesting though, because there's this debate in psychology about emotions, and I'm going to link this up to Taleb in just a moment. So this idea in psychology is it the chicken or is it the egg? Like, when we feel emotion, is it because we feel our body tensing up or doing whatever it does, and then we say, oh, I must be anxious right now? Or is it that you get anxious and then your body starts to tense up? And it's the same thing, I guess, when you think of what Taleb talks about, right, with the black swan, which is we have these things happen in the markets and in fact throughout history, and then later on we kind of overlay it and kind of massage it and make it look like, oh yeah, well that's why this happened, right? Like, that's why Hitler was able to secure power. That's why we had the GFC. It's kind of this hindsight bias where we massage it and make it all fit into the box after the fact.
Yeah, it's this idea that any reason is a good reason. You heard that saying before?
Yes, and I know you're a big fan, as I am, of Taleb, and the this idea that, I remember explaining this to a group of traders. We were like this was the trading tribe that I used to go to, which is Ed Sequoia's group, and he has these around the world. And we were talking, and I was talking about, it was when I had first read The Black Swan, and I was explaining the basic idea, which is, these things happen, these shocks happen, and then we go back and we explain them and make them fit. And, it was never that Hitler seized power. It was that Hitler had this slow build of power. You know what I mean? Like, these things are never just all of a sudden out of somewhere something happens. It wasn't that the GFC, we wake up one day and there's a GFC. No, it was a slow accumulation of junk debt, that led to the GFC and things like that.
Yeah. We're obsessed with this cause and effect thing, aren't we? That every outcome has like a real obvious reason. And what I see, and especially in trading, there's like so many little elements of luck that come into that as well. Talking about Hitler, to get where he was, there was a lot of luck along the way there for him. Anyway, he should have been kicked out of the party, and elements of luck kept him in there. And I think, I see it all the time in people's trading. They try to explain every movement in a chart and why they, hit their profit, and why an entry stopped out. And I've stopped thinking that way a long time ago now.
Yeah, right. Yeah, I mean, at the end of the day, like, you can do whatever you want, and you can plan for everything, and like, the market's going to go where it's going to go. It could miss your target by 1 pip and then reverse 500 pips after that. That can happen. And so, yeah, I mean, you just have to, I mean, that's the great thing about trading though, like the uncertainty. You have to just embrace the uncertainty and go, you know what? This is what we get paid to do. We get paid to look at this and just say, yeah, I don't know what's going to happen, but here's my risk capital and take it. do with it what you want, market, and we'll see we'll see where we end up.
Yeah, I think those people who never really embrace it are the ones who kind of never get there, really. As long as you're trying to look for reasons for every little outcome in all of your trades, I think you're stumped.
Yeah, they want to control it. So do you think that most traders probably are like Alessio Rastani and they dream of the next GFC? Do you think that most traders think that way?
I don't think they do. I think maybe the small percentage of winners do. I think most traders are not thinking that way. They want to think that everything is, you can determine every movement that's going to come, and you can plan it out, and you're going to get your expected returns, and nothing unusual is going to happen. The only other outcome you're going to get is the one that you expected to get. And, even if you're not at that point yet, at some point you will get there, and that means that you're a good trader. I think the majority of people think like that.
Yeah, that's interesting.
I'm always hoping for a housing price crash. I'm always hoping for that.
Yeah.
Just to prove that I was right.
Yeah.
As much as anything.
Yeah, I know. I mean, it's one of those things like, like you can, the market can prove you long, just long enough to milk, to drain all your account, to get all of your money, and then allow you to and then allow you to be right. Those sorts of things. You hear those stories of Burry in the Big Short, where he was stretched to his limit, and isn't that the case? Like, I remember when I first started trading, that there was a lot of those trades where it just felt like at that very point where I just had to throw in the towel. I couldn't take the pain anymore of the losing trade. I'd already moved my stop and kept moving my stop and kept moving my stop. Luckily, I wasn't big into averaging down, like where people would add to a losing trade. I don't know why. I didn't really get into that. I did a little bit in the very early part, but what I would typically do, my big mistake was to keep moving my stop. And so what that did is it kept increasing the loss. And eventually I would just finally say, okay, I can't take it anymore, and take the loss. And it was amazing how often that was actually the end of the move. Like as soon as I threw in the towel, that was the turning point. And it's crazy.
I think that's where you need to live as a successful trader. You need to live right on the extremes there. And as soon as you try and find the sort of comfortable middle ground, that's the place where there's no profit or edge to be had. Whether it's continuing to take entries when you've had a string of losers, or having a string of losers and then holding on to your winner until it reaches your target. It's kind of those extremes. It is those shock. If you think, really every trade, you should be looking for that shock event, whether that be having continual winners with a really small target, or holding trades for very big winners. It's those extremes is where the success is in trading. So in a way, going back to the original point, you're right. You have to be hoping for the next big shock event, because I think that's where the money is to be made.
Yeah. But what's interesting to me is I have a lot of friends who are older retired gentlemen who aren't traders, they're investors, and they're fearful of they just want to ride the blue chip stocks out, and they want to see the markets go up, and they just want to, that's what they want. They just want the status quo. And as a trader, that's, I'm always trying to remind them that, that's not the way that the markets always run. And, at the very least, you should have some downside insurance, like in the form of options or whatever. And a lot of times these guys, and I've learned a lot from these guys. I'm not disputing that. I mean, these are like mentors to me, these older gentlemen who are retired and have lots of life experience. But I think that it's interesting to me that they don't see it that way. I think they underestimate the risk that their capital is at when they're just simply long shares. It's crazy to me. It's like somebody who's a property investor and they just invest in one city. It's just like being long one company. I'm just going to buy Apple, and every time I get money, I'm just going to put more money into Apple. That's crazy to me. But people do that, and they consider it normal, and they consider it's what you should do. Take all of your retirement money and sink it into property investments or whatever. I mean, it's just crazy to me, but I would never do that as a trader. I look for ways to diversify risk. And it's just fascinating to me that the share investors are kind of on the opposite side of the spectrum. I suppose they kind of want low volatility, and they kind of just want the markets to just keep steadily marching upward, really, I suppose. And they don't really want any shocks to the system. And they diversify. To me, they diversify. And I know I'm being very general here, but I think your standard share investor doesn't really do much in terms of diversification. Like, they think that if they buy Tesla stock and General Electric stock and Bank of America, they're diversified. You know what I mean?
Yeah. I mean, I've been looking at this in forex trading recently. That I've been looking at how to diversification with different strategies and different currencies. It never works for me looking at different pairs. I find it's just like a curve fitting thing, isn't it? You flick through until you find a chart that would have given you a good winning run, and you instantly think, well, the answer is just to keep adding instruments, and you're bound to hit the winning one sooner or later, but it doesn't work, does it?
No. Yeah, that's right. It doesn't. Again, we're fighting our fighting our instincts, aren't we? To get at the very point that you give up is really the turning point in the market, and these sorts of things seem to creep up for traders. Well, Darren, I guess I would say that the speculator is looking for the next big bad news to come out. Unfortunately, I think that's where we're at. I don't think it's necessarily immoral, though. I think that's overplayed. You think about businesses or industries that collapse. Look, for example, railroads used to be the big industry, and then they sort of collapsed and gave way to the automobile. Well, there'll be something else that comes around, after the automobile, and the automobile industry will disintegrate. And so, it just there's innovation, right? So you have new industries that are born, and grow from the ashes of the stuff that's been totally obliterated. So I don't look at it that way. I think it's more of a cycle of rebirth, really, than just we're all happy that Union Railroad is no longer in the Dow or whatever. They've gone bankrupt. It's not really that way.
Yeah, and I don't think it's down to us as traders to make the world a moral or immoral place. We don't really have that control, do we?
Yeah, that's right. Exactly. Like, we don't make, for example, maybe thinking that the yen is going to depreciate. You don't make it depreciate. You just look at your chart, you look at your trading system, and you say, well, it's telling me the yen's going to depreciate. So you're not happy that the people in Japan are losing their buying power. Like, that never comes into my, I never think about that. It just doesn't. It's just weird that people would say that. I think it's an easy out for people who want to demonize trading or capitalism in general. They just say, well, you're a dirty trader. You're capitalizing on other people's suffering. Well, I don't know about that. I mean, I think, I don't think that's what's going on here.
Yeah.
Anyway, well, it was great to talk to you, Darren, and we will see you in the next episode. Thanks for your time.
Okay, Walter. Thanks a lot. I will see you soon.